Prices for Russian crude shipments from Black Sea and Pacific ports have fallen to their lowest level since the start of the war in Ukraine. Our guest says there are signs that crude may well continue to grind lower regardless of a peace deal. Let's get more from Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thanks very much for joining us. Stupidly, before the break, I said, oh, it might not be a big deal, a peace deal in Ukraine. Of course, it would be a huge deal for humanity and end the suffering there. But I think what I meant to say was some oil market participants think Russian crude's been getting out anyway, so it may not be seen as that significant a ceasefire.
Yes, Andy, and I think your point's well received. It's a huge deal in some regards, but for the crude market, it may be more of a headline risk, and we may see that knee-jerk reaction if we get a peace deal, because in reality, we really haven't seen Russian flows impacted over the course of this conflict. Now, as you mentioned, the Russian barrels are deeply discounted, so they're trading at a heavy discount. Shipping costs, it's driven higher shipping costs and insurance costs. But at the end of the day, when we look at supply and demand and balances, the barrels are out there. The last month is a little bit different because we have seen some self-sanctioning from India, in particular, as they look at the latest round of sanctions and have pulled back on some purchases, which is why we see a tremendous amount of Russian barrels on the water. So it's not that their production has gone down or their exports have gone down. We just have more barrels on the water. And that is applying some pressure to the commodity. But I think you're right in thinking deal or no deal, the market and traders see balances remaining the same. Maybe some short-term disruptions if we don't get a deal as there's sanctions threat. But in the event of a deal, sanctions aren't going to be unwound instantaneously. That is going to be something that's proven over time. So the market really sees this as kind of a lockjam between maybe seeing a little bit less friction in the market in terms of shipping costs on a deal. And then if we don't get a deal, maybe more rhetoric around sanctions. The thing that's really driving prices right now, though, is the supply and demand balance heading into 2026, which most market participants and everyone is well versed in are seeing really large builds in the first quarter of 2026 and how that is kind of impacting day over day trading as the market prepares for a really well supplied, oversupplied market in the first quarter.
You note that so-called paper barrels look oversupplied, and that, of course, is the barrels traded in the financial markets. Is it a slightly different story when you consider actual physical barrels out there?
Absolutely. So that is the big kind of battle that's being waged in crude right now. If we look at time spreads, which is a physical market indicator of demand and strength in the marketplace, we're in backwardation, which indicates that demand is strong. Spot demand is stronger than what we're looking out down the curve. So that would not tell us, if we just looked at time spreads, that we're looking at a massive build coming in the coming weeks. And the reason the physical market isn't translating the way the financial market is a lot of the builds that have come have been shipped into strategic petroleum reserves in China. So these barrels haven't showed up in traditional kind of commercial pricing centers like Cushing for WTI. And so it's kept time spreads tight. But if you're a financial player and you're looking just at the macro picture, you're saying this is a well oversupplied market. There are more barrels out there than we are consuming. Whether they show up in Cushing or in OECD inventories, we don't care. And so there's where you kind of had this market that's kind of doing battle with itself. I will say this, though, consensus and positioning really in the financial markets is very short in the paper markets. CTAs, macro investors, hedge funds are all leaning very short. So if these builds don't come in as big as we expect, you actually could see a market that rallies even in a building inventory environment.
Isn't that interesting? Yeah, that's the way. I mean, a lot of people, smart people are buying oil right now. I know some of it's hedging, et cetera, or people are actually going to use the oil. But bearish sentiment can be a good sign.
Well, I think when it gets overly bearish and it's a little bit too consensus, it can be because everyone's leaning too far to one side of the trade. And even if that trade comes to fruition, there's really only one thing left to do, which is cover your short eventually. So I think when we look, though, at first quarter of 26, there will be continued pressure. These builds I think are going to start to materialize. It's just how much downside do we see? I don't think we see this move into the low 50s of TI. Maybe we see mid 50s and kind of grind around there. But when we think about how the market rebalances itself, that's where we need to start answering questions. If we're going to have these builds, what happens? Is it OPEC? Does OPEC change course? Is it a supply adjustment from like high cost producers like US shale? Do we get to see increased demand? Or do we see China put more barrels in SPR, right? So we need to think about those balancing mechanisms and where we think that's most likely to come from. I think it's going to be a combination of supply and China SPR that softens the blow of those builds. And maybe we do start to find a base in the mid 50s in TI and maybe in the low 60s in Brent. And if we can work through these inventories, maybe we put ourselves in a position to rally in the second half.
Just very quickly, I'm sorry we're tight for time, Rebecca. Exxon coming out with a pretty optimistic forecast on cash flow. Just remind us, in the Permian, are American companies making plenty of money right now?
They are. At the current strip, they're still making money. Plenty of money is questionable. The important thing out of the Exxon release is that they're going to be able to be more efficient with the reduced capex or the same capex. They're expecting to grow production. This has been the trend for years. U.S. producers have gotten continually more efficient, and that's the one thing to watch when we look for a supply adjustment at lower prices. Have they just become more efficient so break evens are now lower? So I think that's a critical point and something to really watch closely in 2026.
Thank you very much, Rebecca. Really appreciate it. Rebecca Babin, a senior energy trader at CIBC Private Wealth.